Hello, and welcome to Carnegie Kubik's first quarter of 2017 Capital Markets Outlook. Today we'll be discussing what we're seeing from some key economic indicators, how these conditions are affecting the financial markets, and how we're positioning from an investment standpoint. So let's get started. The key themes we'll be focusing on will include the performance we've experienced in the first quarter of 2017, where the financial markets are now from a macro, style, and sector standpoint. Are those markets overvalued or undervalued? We'll discuss the implications of recent actions taken by the Federal Reserve, as well as some ongoing domestic and geopolitical issues. The domestic equity markets had a strong first quarter, with S&P 500 growing by about 5.5%. This continued bull market has further been fueled by increasingly high consumer sentiment and market confidence. This has pushed valuations of companies to levels that might be considered fully valued and perhaps a bit overvalued. Looking at the chart here, we're considering a historical forward price-to-earnings ratio compared to that of today's levels. This ratio is one of hundreds of valuation tools we use to determine whether or not the markets are over or undervalued. In this case, we can see that the current 17.5 multiple is a bit higher than the 25-year average of 15.9. This implies that the S&P 500 is a bit overvalued. Looking at other valuation metrics, like price to sales or price to cash flow, we do see similar themes. However, from a price to book or earnings yield spread standpoint, the market appears to be appropriately or slightly undervalued. From Carnegie and Kubik's perspective, we would say that for the first time in quite a while, we are slightly overvalued from a historical valuation perspective. There are still areas of the equity markets that we feel are undervalued, and given the U.S.'s relative economic strength, we believe this valuation premium is justifiable. We do not believe we are in a danger zone from a valuation perspective. However, the intrinsic valuation methodology and fundamental analysis of our underlying holdings has become a much more significant factor in current times than it has in these past few years. Given these slightly above average valuations and the length of this bull market, you might start hearing some chatter about a potential pullback. As always, a short-term pullback is a possibility. However, it's important to understand that there's a big difference between that of a pullback and a bear market. Pullbacks are natural parts of the market cycles, and they do happen on a regular basis. A bear market, on the other hand, is a negative economic shift that is generally triggered by macro events. Take a look at this chart. It takes a look at historical bear markets. As you can see, in almost every case, there were multiple contributing factors. Specifically, was there a recession, a commodity spike? Was the Fed being overly aggressive? Or were we experiencing a time of extreme valuations? We would argue that we're not experiencing any one of those things. While the economy hasn't been booming, we are steadily and consistently growing economically, so there's no recession. There hasn't been a commodity spike, and the Federal Reserve is not being aggressive. In fact, the Fed is being very accommodative and has been incredibly transparent with what their intentions are regarding the Fed funds rate. Additionally, we are not in a period of extreme valuations. While the equity markets may be slightly overvalued, we are still within a normative range. Further, we would argue that a higher valuation premium has been assigned to the United States markets because our economy is stronger and growing faster than that of other developed nations. While we feel good about where the U.S. is from an economic standpoint, there are a number of domestic and geopolitical items that warrant concern and do have the potential to impact all the financial markets. These items include whether or not the Affordable Health Care Act will be repealed. Will promised tax reform occur in the manner consistent with what expectations are? Will the trillion-dollar infrastructure spend take place, and if so, how will it be financed? Will Dodd-Frank be repealed? And what will happen next around the world? There's an increasing focus on North Korea, Russia, Syria, and China. As always, there are events that can move the markets off track, and these are a few of the areas that we are currently tracking very closely. This is a relatively straightforward chart that depicts the historical impacts of the Federal Reserve raising the Fed funds rate. In looking at the returns of the S&P 500 following past rate hikes, we can see that in almost every period the equity markets improved subsequently to those hikes. The explanation for this is pretty simple to understand. When the Federal Reserve feels confident in the current state of the economy and where the expected growth of that economy is, it recognizes its ability to increase the Fed funds rate. If the Fed is correct and the economy continues to gain strength, the equity markets are rewarded as they take advantage of that growth. The Fed clearly feels strongly about our economy and has guided us to expect 2 to 3 more rate hikes this year. In addition to the confidence seen from the Federal Reserve, consumer confidence and market sentiment has continued to grow higher and higher. Because of this expectation, growth companies positioned to take advantage of improving economic conditions have been rewarded, more than that of value-oriented companies. This is a bit of a reversion of the themes that we've been experiencing for most of this bull market. After pricing in the impacts of the election late last year, the markets appeared to have returned to focusing on growth trends, market positioning, and fundamental information. Growth-oriented sectors like technology, consumer discretionaries have performed better, and more defensive sectors like utilities, consumer staples, and real estate did not perform as well this quarter. To further illustrate the significance of this shift, take a look at this chart. Considering the great outperformance of value in the last couple of months of 2016, following the election, and compare that to the dramatic outperformance of growth in the first quarter of 2017. As you are all aware, towards the beginning of last year, we shifted our equity strategies from a growth tilt towards that of a neutral stance between that of value and growth. This wasn't because we felt like value was equally as attractive as growth, but rather because we saw a market momentum shift towards value. It was as a result of the uncertainty that was pertaining to the impending election. Not wanting to fight the markets, we followed suit and shifted a bit more defensively. After the impacts of the election were priced in, the value-oriented securities have become even more fully priced. And late last year and early this year, we began shifting back towards a growth-tilted portfolio. As you can see from the chart on the right, our broad equity model, known as our core equity model, currently has about 9% overweight to large growth over that of large value. This overweight is primarily due to the types of sectors and companies that we expect to most benefit from current economic conditions and the market cycle that we're currently in. Additionally, we find growth-oriented companies look more attractive than that of value from a relative value standpoint. Before commenting on the chart on the left, I do want to note that the historical price-to-earnings ratios on this slide are based on a 15-year time period, which is not necessarily the best historical time period for this comparison. It is important to understand that we believe the true target ratio to be a bit higher than what's shown here. But what I really want you to recognize in this chart is that from a historical valuation perspective, growth does appear to be more attractive than that of value. The markets rewarded this positioning over the past quarter, with the growth sectors of technology and consumer discretionaries being the top two performing sectors. A couple of other sectors to note include healthcare and energy. Healthcare performed quite well, much of which can be explained by their 2016 performance, denoting their out-of-favor status, and current valuations being meaningfully lower than that of historical ranges. Energy, on the other hand, can be explained by the volatility in the oil markets, as well as what has been transpiring throughout the Middle East, as well as in Russia. Much like our earlier discussion between value and growth, take a look at the deviation between the last couple months of 2016 and that of the first quarter in 2017. We can see some significant shifts in underlying performance of some of the sectors. Consider the shift in technology, discretionaries, and healthcare. These were some of the lower performing sectors late last year, post-election, but stepped back into the lead in this first quarter. On the other hand, look at some of the top performing sectors of late last year: financials, telecom, and energy. These became the worst performing sectors in the first quarter. Obviously, this is a very short time period. However, we felt the significance of this shift was worth noting. Let's now discuss how we positioned our core equity model from a sector standpoint. On this slide, we look at the weights of the sectors comprising the S&P 500 and that of our core equity model. As you can see, we have had a slight overweight to that of financials. This is due to the universally expected repeal of the Dodd-Frank Act. While financials can be considered slightly overvalued, should this repeal occur, financials, and specifically banks, should benefit greatly. Technology remains our largest overweight and appears to be one sector that has the most wins behind its sales. As you know, through 2015, healthcare was one of our largest overweights, but then when it moved out of favor, we moved it to our largest underweight. Stocks in this sector had become quite undervalued, and at the beginning of the first quarter, we moved back to a market weight. Between the industrial and material sectors, we have a slightly overweight position for the expected infrastructure spend. We have market weights in consumer discretionaries and staples, primarily because of their slightly higher than normal valuations, and we have underweights to utilities and real estate because of the overvaluations there. We feel strongly about our current over and underweights here, but are ready to make any necessary tactical shifts should new data present itself. Switching gears and taking a look at the fixed income markets, an initial reaction might appear to tell a different story than that of the equity markets. With bond yields being low and bond prices being high, one might see the demand-driven pricing of bonds as a flight to safety by investors. However, it is important to understand all of the moving pieces before driving to any conclusions. Let's compare the U.S. bonds to that of other developed nations. As you can see, the U.S. has the highest interest rates of all these countries. That implies that the U.S. has the riskiest of all these countries. Obviously, this is untrue, but looking solely at interest rates, you might jump to that conclusion. The missing piece of information in all of this is that the quantitative easing strategies that these countries have put into place to promote economic growth. Unfortunately, these policies are not taking root there, and it appears as though their interest rates will be there for some time. These policies have had a direct impact on the U.S. fixed income markets, as why would anyone purchase a Spain bond for a lower yield than a comparable U.S. bond? This lack of demand for European income products has increased the demand for our income products. This has increased the prices and thus lowered the yields of our bonds. Another interesting factor is that the Federal Reserve just raised rates. The short end of the curve did move up as expected, but the longer end of the curve shifted down a bit. This implies that the markets are expecting us to be in this type of interest rate environment for some time. The last point I'll note is that these interest rates we're looking at are for U.S. Treasury bonds and other sovereign debt. Treasury bonds are generally thought of as the least risky and thus have lower yields than other income-producing securities. In conclusion, while we do feel like some areas of the markets might be a bit overvalued from a historical perspective, we do feel good about where we are economically and where we believe we are headed. We believe the U.S. markets are continuing to grow faster and are stronger than the rest of the world, and because of that, we believe they can demand a bit higher of a market premium. That said, given the current state of the markets, the factors of fundamental intrinsic valuation analysis are increasingly important, and avoiding excessively overvalued areas in the market is critical. We are continuing to position in efforts to reduce downside risk exposures while maximizing your risk-adjusted returns. Thank you for placing your trust in us, and please know just how much that means to all of us. Please reach out if we can provide you with any additional information or clarity on any of this. Take care, and we look forward to speaking with you soon.